Good afternoon. I want to thank everybody for logging in and calling in today for our webinar on what can you do with your old 401k. In the seminar today, we will talk about the different options you have when you have money sitting in an old 401k or perhaps even IRA accounts as well. What are some of your options that those 401k companies, those other custodians who hold your retirement funds won't make you aware of? What are some different things that you can do? So we'll hopefully answer a lot of questions today about what a self-directed IRA account is. For anyone who's listening live to our webinar today, if you have questions as we go along, please type your question into the chat box on your screen, and I'll make sure I get those answered for you. If you are watching the recorded version of this webinar, my contact information will be at the end of the webinar. You can certainly reach out to me by email or phone at that time, and I'll be more than happy to answer any questions you have over what we talked about today or possibly other things that we're just talking about in general. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I'm also a licensed attorney. I don't do any legal work for Advanta, but I've been with the company since early 2006, handling a lot of the transactions for individuals and basically walking them through the process of opening an account and then getting their assets invested and getting their cash invested into the alternative assets we have here at Advanta IRA. One quick disclaimer, things we don't do at Advanta IRA, to make it clear, is that we do not give investment advice, and we also don't give any legal, tax, or tax advice. Now, we will talk today about some legal issues, some tax issues, but when it comes time to making an actual determination of whether or not you should make a decision within your IRA from a legal or a tax position, we would refer you to an attorney, maybe to a CPA or someone who can help you make that determination for you and give you and analyze it and give you advice. That's just where we have to stop. We can make information available. We just can't actually give permanent give advice to you on how you should proceed. And certainly as it comes to investments within an IRA account, again, we will make the options available to you. And the point of today's webinar actually letting you know some of the different things people do with a self-directed IRA. But when it comes down to choosing an investment or choosing whether that investment is right for you, it is up to you to make that decision. Now, a quick background on our company. We are been around since early 2004, and since that time, we've only ever administered self-directed, basically qualified money. We don't handle any savings accounts. We simply handle IRAs, old 401ks. And doing so in administering a self-directed retirement account. We do not hold brokerage-type accounts. We don't hold mutual funds or stocks or CDs. Those are what you would find in a more typical custodian, but it's not something that we hold at Advanta. We focus really on the alternatives and holding the real estate, the private notes, and other unique investments that we'll talk about today. Our difference, I think what sets us apart in the industry, is we really have a local feel and basically a concerted effort to focus on customer service with our clients and providing them with the best feedback, the best access to us and the information regarding their account. So each account that is established is assigned to an account manager, one person who will receive all the correspondence, will be your point of contact when dealing with your self-directed IRA account. You're not calling an 800 number and waiting for the next available person to come on the line. Now, why haven't most people heard about self-directed IRA accounts? I think the biggest reason is that most people have their IRA or have an old 401k, and it's administered by a bank or a brokerage firm, a company who is offering you basically the products that they sell, whether it be mutual funds, whether it be stocks. IRS regulations do allow for a very, very broad range of investments. It's not limited simply to stocks, bonds, mutual funds. Some of those companies would like you to think that, but IRS regulations do allow for a much broader range. Now, the restriction, though, or the permission the IRS gives is that each custodian does not have to hold all of the permissible investments. So a brokerage firm makes a decision to simply hold the alternatives or the more conventional assets. At Advanta, we hold the alternatives, the kind of things that fall through the cracks, the things that they will not invest in. So you might have a lot of our clients have an IRA with a brokerage firm or with a bank holding kind of more conventional assets, and they may have an IRA with us holding the alternatives because no one custodian is required to hold it all. Now, a couple of the main reasons we see people invest their IRAs or their 401k funds into alternative assets One, it's for a lot of clients, it's a new source of capital. If you're looking to invest in a piece of real estate or make a private loan or maybe invest into a new startup company, individuals find that they have their capital, they have their cash being held in an IRA account, and that's the cash they want to utilize to make the investment. So they choose to actually use their to self-direct an IRA to make a particular investment. It's not necessarily from a tax decision, not from that kind of place where that's driving the driving force. It's just simply this is where their money's at, and that they want to use it to make the investment. Let's figure out a way to do it, and a self-directed IRA helps them reach that. For some clients, though, it can be a tax decision. If you're anticipating large gains from an investment, you're in a high tax bracket now, it might make sense to have that investment held within a self-directed IRA so that the investment income that's generated simply comes back into the IRA, either tax-deferred or tax-free if it's a Roth account. So individuals will choose to self-direct at times from a tax decision, but it seems most of the reason we see individuals self-directing, it's because, again, it's a new source of capital for them to use, and also sometimes the investments, they just seem to understand a lot more and want to use their IRA funds to make that. Now, as far as the investment types we see, any type of real estate can be held in a self-directed IRA. It doesn't matter what form the real estate takes. It does matter what you can do with the real estate that we'll talk about a little bit later. But we have clients who hold raw lands, commercial property, rehabs, flips. Most common asset is probably a rental property, whether it's a single-family home, whether it's a condo, duplex. It doesn't matter. As long as it has a deed, your IRA can own that particular asset. It doesn't matter what you do with the asset, where the restrictions will come in that we'll talk about in just a few minutes. We see a number of other individuals invest in what we call paper assets. Your IRA, maybe instead of your IRA buying a rental property or buying a property to rehab, your IRA could be lending money to somebody else. Your IRA acts as a private bank, lending money to a third party. They, in turn, use that cash to acquire a property, get it fixed up, and then share the income with you or simply pay back your IRA an interest rate. We also see individuals investing in tax liens, unsecured notes, assignments, joint venturing, just a lot of different unique things that you can do with contracts and with promissory notes. So it's kind of, we have this other category we like to call our paper category because it's not the physical real estate that someone's buying. It's just this other paper asset that may be tied to real estate. Additionally, kind of the other alternatives, we'll go over the rules in just a moment. The IRS does not publish a list of all the permissible investments you can make within an IRA. They simply have rules that limit what you can do. So there's certain things that you can't do. Again, we'll talk about that in a moment. But just some of the other alternatives outside of real estate and some of those paper assets, individuals investing into LLCs, farm animals even, partnerships, movie projects. The list goes on and on. Again, the IRS does not have a finite list of investments. There's a lot of different things that you can do. In fact, LLCs are quite interesting because we have a number of clients who invested in LLCs, some of which are they call the checkbook variety, the Checkbook-Control IRA, where it's just your IRA owning its own LLC. We'll talk about that towards the end of the presentation today. But we also see individuals using their IRA to invest in private LLCs, maybe where there's several different members in the LLC, maybe several hundred members in the LLC, and the IRA is just but one of those individual members. Now, as far as what accounts can be self-directed, so if you're thinking about making an investment into real estate, into notes, into a private LLC, what funds can actually be used to create a self-directed IRA to make that investment? Any type of IRA, whether it be a traditional or a Roth, which are the individual accounts, or whether it's a SEP or simple IRA, which are what we call the employer-based accounts, where if you own your own business or if you're involved or you're an employee of a small business, you may have access to a SEP or a simple IRA account. The difference between the SEP and the simple and your regular IRA is simply the SEP and the simple allows you to contribute a lot more money in a given year. So if you are a sole proprietor, if you own your own business, utilizing a SEP or simple can help you defer a lot more of your income each year and help bolster what's in your retirement account. We also offer individual 401ks for sole proprietors. It's a kind of an alternative to a SEP or a simple. And certainly any former employer plan. That's what we're going to spend a few minutes about today, talking about Any old employer plan, whether it be a 401k, a 403b, a 457 plan, those kind of those terms all refer to different IRS code sections. But these employer plans, once you are no longer working for that institution or that company, you're allowed to move that money into an IRA and in turn self-direct and control those assets and control that cash into investments that you see fit. Now, one account that's not on this list is a current 401k or a current employer plan. You do have to check if you're involved in a business or a company or, again, maybe a local government where you have a 401k or a 403b plan. If you are currently employed by that same company, you have to check with them to see if you have the ability to do a rollover to an IRA. A lot of current employer plans do not permit you to roll over funds from those plans into an IRA as long as you are still employed there. But once you are no longer there employed, whether it's you've retired, you quit, you got laid off, those old employer plans can certainly be rolled over into a traditional IRA account. Now, the mechanisms for moving money from one account to another depends on ultimately where the funds are coming from and where they're going to. If you have money in an existing IRA and you're looking to move those funds to an IRA with another firm, so maybe you have a Schwab IRA and you want to move some of that cash into an Advanta IRA, that is handled as a trustee-to-trustee transfer. So transfer is the word that is used in the industry, basically moving money directly from one IRA to another IRA without the client or the account owner actually handling the money. Because the money does not touch the client's hands, it's a non-taxable, non-reportable event. So you can move money between IRAs via transfer as often and whenever you like without any tax repercussions. The other way to moving funds, if you do have money and retirement dollars in an employer plan, like a 401k, a 403b, etc., you can also move those funds into an IRA directly without touching the money and also have it be a non-taxable event. That is referred to simply as a direct rollover. So you're directing the administrator of the employer plan to do a rollover to the IRA. They cut the check directly from the plan to the IRA, so the money never actually touches your hands or goes into your account. Again, also a non-taxable event to roll over from a 401k to an IRA. Pardon me. The last way to move funds from one account to another is what they call an indirect rollover. This is something we don't encourage people to do because of the limitations involved with doing so, but it is permissible to personally take possession of money from an IRA or an employer plan. So basically have that other company issue you a distribution to your own account, and if you get that money back into an IRA or another employer plan within 60 days, you will avoid the tax repercussions. But you can only do that once per 12 months, and it does create reporting and taxes that would ultimately be due. So typically if you're moving money from an IRA to an IRA or a 401k to an IRA, we'd strongly encourage you to use either a transfer or a direct rollover to get those monies moved. And again, it's important to note that transferring money between IRAs or doing rollovers from old 401ks and also earnings within an IRA are unlimited. So there is no limitation if you have your funds invested and you're making so much, you're making 15% on your money, there is no restriction on earnings within an IRA. The IRS only limits how much you can contribute in a given year to your retirement account. So what are the different employer-sponsored plans that are out there? There's kind of go over some of the, I've been mentioning some of the acronyms, again referring a lot of times to the different code sections in the IRS code that allows for the creation of these plans. What exactly are they? Kind of what's the difference between them? Start off with the 401k. Now, a 401k is a defined contribution plan. And again, these are usually held by private institutions, private businesses, that allows employees to defer their salary. So an employee can actually choose not to take some of their salary, instead put that into the 401k plan. And a lot of times companies will then do a profit sharing match of a certain percentage for each employee who contributes. So it's called a defined contribution plan because the company will define how much they are going to contribute to the plan. They don't define how much you're going to get maybe 30, 40 years from now, which would more be a defined benefit plan. But a defined contribution, the company says, we're going to put in X number of dollars as long as you defer some of your salary. And then going forward from there, it's your responsibility as the account owner to grow that, choosing from a variety of different funds. So 401k, again, it's usually for private companies that features both salary deferral and a profit-sharing match on the company. Sometimes companies may delay or discontinue the profit-sharing match, but the employees still have the option to make their salary deferral contributions. 403B plans, these are typically found with public education employees, so your school teachers, people who work for the local school districts, also some nonprofit organizations as well. And these also work very similar to a defined contribution plan and a 401k, in that they allow for the employee, if they wish, to defer some of their salary, and then the company, in this case the public education institution, the school district, also does a match and puts some money into the 401k on behalf of each employee as well. 457 plans are also deferred compensation plans, again where they're deferring for basically a portion of your salary or what your overall pay would be into a plan. This is for governmental employees, typically local, state governments, even some federal government employees as well. One of the big differences with a 457 plan, unlike a 401k or an IRA, is you can actually take money out of a deferred comp plan, a 457 plan, prior to 59.5 without paying any type of penalty. With an IRA or with a 401k, any monies you pull out prior to 59.5 are hit with a 10% penalty, but that does not happen with the 457 plans. The TSP plan, or the acronym is for a Thrift Savings Plan, that is also a defined contribution plan, similar again to a 401k, for United States civil service employees, so your postal workers, and also members of the military, where again, those individuals are choosing to defer a portion of their salary, and then the federal government actually then does a match as well into that particular TSP plan. Now, the other type of employer plan that's out there that we see from time to time, but not around nearly as much as it used to be, are pensions. Now, prior to the advent of the 401k, a lot of companies, when they were looking to reward their employees or entice people to come work for them, offered their employees a pension plan. And these pension plans are defined benefit plans, not defined contribution plans. So again, with the 401k, the company will define how much money they will put up front into the plan, but they do not define the benefit at the end of the day. With a pension plan, a company offering you a pension would say at the outset they will give you X number of dollars per year in retirement based on so many years of service. So it's a defined benefit that you know how much money you're going to be getting per month when you hit retirement age. The problem with the pension plans that the 401ks kind of solved was that companies that were offering pensions were on the hook then to make sure enough money was socked away and that investments performed well enough to pay out those defined benefits later on down the line. So a lot of companies it was incumbent upon them to make sure that their pension plans were properly funded and were properly growing because they had to meet a specific benefit. And that's why a lot of companies have chosen instead to go to the 401k, where the onus is not on them to make sure there's enough money there in the future. It's just simply making the profit-sharing contribution at the outset with a 401k. The question just came up in the chat box. Again, as you have questions as we go along, please type your questions into the chat box. I'll make sure I get to them. The question says, under the 457, why do the government employees have preferential treatment over free enterprise individuals? And unfortunately, I don't have the answer to that question. I'm not sure exactly why there is no 10% withdrawal penalty before that age. If it might have to do something with just the simply fact that they're government employees, I don't know if that's specifically for congresswomen. We can speculate there. I'm not sure, but to be honest, I'm not quite sure why that there's no penalty for that. So that'd be a good question. I'll try to research or find out. You can do some research on your own and see if you can find a reason why the government employees get that preferential treatment. Okay, our next slide, talking about the, actually, wait, hopefully it's going to jump here in a second. I apologize for having a moment here with our conference controls not bumping onto the next slide. why it's not displaying in our screen. So give me just a moment here, and hopefully this will resolve itself. All right, there we go. So what type of IRA, if you have money in an old employer plan, so you have that 401k, you have that old 403b plan, what type of IRA are you eligible to move that plan into? Well, if you move the money from an employer plan as a rollover into either a traditional or a SEP IRA, you could do so without any tax consequence, going from a pre-tax 401k or 403b plan into a pre-tax traditional. So it's a like account to like account. There's no tax consequence for moving the money in that fashion. The other alternative you might have would be to roll that employer plan into a Roth IRA. Now, a Roth IRA is a tax-free retirement account as opposed to a traditional IRA or a SEP, which are tax-deferred. So the contributions or the conversions that go into a Roth IRA end up growing tax-free over the course of a person's lifetime. So if you were to roll money from an employer's plan into a Roth, the IRS treats that as basically doing a conversion, which is taking money in a pre-tax retirement account, moving it into a Roth. You will then have to include in your income the amount of the rollover the year that rollover is made. So if here in December of 2015, I were to do a rollover of, say, $30,000 from an employer plan into a Roth, I will get a 1099 for $30,000 and have to include that in my income for 2015 and then pay the taxes that would be due on that. Now, going forward, the money's in the Roth is going to grow tax-free, which is great, but I would have that consideration up front of how much tax am I ultimately looking at by rolling over from the employer plan into the Roth IRA. So you have the option with an IRA to either open up a traditional or a SEP and just move the money over from the 401k to that account, no tax consequence whatsoever, or instead rolling that money into a Roth IRA, but treating it as a conversion. Therefore, you're going to have to pay taxes due on the amount that gets rolled over. And the money, when you do a conversion to a Roth, the taxes don't get withheld. The full amount gets moved from the employer plan to the Roth. You're then expected to pay the taxes from the balance of what you have personally. So one of the genesis of a self-directed IRA is if you have money in an old 401k or even an IRA, is to not take the money out of that plan to buy an asset or make an investment in your personal name. If you remove the money from those accounts personally, you'll be subject to taxes and possibly penalties for taking an early distribution. But by having a self-directed account, you can roll over these old 401k funds into a self-directed IRA, preserve all of the capital that's involved, and then in turn direct us to make these alternative investments within your retirement account. So you'll be able to preserve all the capital. You're not going to lose 20 to 30% due to taxes or possibly penalties for moving that money into your own personal account. In fact, we had a few years ago talked to a few individuals who had been doing this, and by the time they realized kind of what a self-directed IRA was and the options that they have, they'd kind of squandered quite a bit of money tax-wise to the government over the years by continuing to take distributions from their 401k and paying taxes on it and using the resulting cash to actually make an investment. But if they'd used the self-directed IRA instead, no taxes or penalties at all, because the money would stay under the tax umbrella of the IRA that they roll over to, and any investments are made in the IRA going forward, no tax repercussions again for the investor. Now again, the possible IRA investments include any type of real estate, a number of paper assets, the mortgage loans, unsecured notes, etc., and the private partnerships. Again, we talked about that a little while ago when we went over the different investments. And at that time, I mentioned the IRS only places restricting rules on self-directed IRA accounts, or I should say IRA accounts in general, and saying there's certain things that you cannot do or things you cannot invest in with your IRA account. So there's no list that you can consult to make sure that you can buy stocks or bonds or real estate or notes within an IRA. The IRS simply stated in 1975 when they created the IRAs, here are the different things that you cannot do with your IRA account. Now, the prohibited investments include life insurance and collectibles. So when the IRS, again, the IRAs were created in 1975, the IRS said there's two things that you cannot invest in, two types of investments that you cannot make with an IRA. That would include life insurance, and that would include, and then collectibles. And collectibles encompass your artworks, your antiques, collectible stamps and coins, or the rare coins. They do permit Under the rules, you'd hold the gold and silver American Eagles and some bullion bars because the value of those coins is not because it's a collectible, it's whatever gold or silver is trading at. The other restriction the IRS placed, though, on IRA accounts that comes much more into our day-to-day operations and in talking with potential investors is the IRS also prohibits certain disqualified persons from transacting with or getting a benefit from the assets held within your IRA account. And it's important to remember when we talk about an IRA or even a 401k that is a distinct legal entity from yourself. The IRS considers your IRA or your 401k as its own legal entity. As such, your IRA or 401k as its own entity cannot transact with yourself as the IRA owner, your spouse, your parents and grandparents, your kids, grandkids, as well as spouses of those descendants, or any business or entity that is owned or controlled by one of those relatives as well. So none of these individuals on this slide can transact with your IRA as far as your IRA buying and selling or borrow, being a borrower or lender between them, and none of these individuals can get any type of current benefit from the asset held within your IRA. So if your IRA is to buy a piece of real estate, it has to be strictly for investment purposes. It cannot be a piece of real estate that you want to live in, that you want to inhabit. It be strictly for investment purposes only. Some people are surprised to learn that brothers and sisters, aunts and uncles and cousins are not disqualified under the rules. So your IRA, for instance, could make a loan to your brother or sister and have them pay your IRA back under the terms of the note. Again, same things with aunts, uncles, and cousins. So the three elements of kind of what would constitute a prohibited transaction. So we have the disqualified investments, the life insurance and collectibles. But a prohibited transaction then involves your IRA or 401k, a disqualified person, and then a transaction between the two. And we define transaction as kind of when you're looking at a closing table, when someone's buying and selling a piece of real estate, for instance. If your IRA and a disqualified person are on opposite sides of that deal, for instance, one's a buyer and one's a seller, that's a transaction between the disqualified person and IRA, and therefore a prohibited transaction. Same thing if your IRA was lending money to somebody who's disqualified. Your IRA is a lender, that person is a borrower. It's on opposite sides of the deal and would therefore be prohibited. What is possible, we'll have a case study that illustrates this in a few moments, is it is possible to partner your IRA with a disqualified person. So if I have some cash in my IRA and I have some cash personally and I want to buy a piece of real estate from a third party, I can do that, and as long as we do it at the same time and have my IRA and myself personally both on title to a specific percentage when purchasing that asset. We've seen most of the partnering situations in Advanta here done where it's been a husband and a wife each using their IRA accounts to buy an interest in a piece of property or to make a loan, etc. So it's kind of a fine line, and when you talk about partnering versus transacting, it's a fine line on how to structure that. That's certainly something we can give you some guidance on when looking to make an investment. Just some other things to consider about before we get into some of our case studies. Other prohibited transaction considerations. If you were going to deal with a brother or sister or family members who under the rules are not technically disqualified, you still would want to deal with them, though, on a fair market kind of arm's length basis. If you were lending money to a brother or sister at a rate much lower than you would with any third party, then the IRS would probably impute that you're getting some type of personal benefit out of doing it, which since you're getting a benefit personally, that would violate the transaction. So we encourage you, if you're dealing with a brother or sister, other family members who are not technically disqualified, make sure you're dealing with them on terms that you would deal with any other third party. Using a middleman between the IRA and a disqualified person, the IRS considers this a step transaction. Essentially, my IRA, for instance, cannot lend money to my son. My son is a disqualified person, so my IRA can't make that direct loan. If instead I were to have my IRA lend money to a buddy of mine, some third party who's not disqualified, with the understanding that my buddy was then going to in turn lend money to my son, they consider that to be a step transaction and prohibited under the rules. So just because you put somebody in between the IRA and a disqualified person, if your intent is to get around the rule it still would be a prohibited transaction if the IRS discovers each step of that deal. Again, I mentioned you cannot use your IRA asset for your own benefit or enjoyment. So if you own a piece of real estate in your IRA, it can't be a vacation home or a principal residence. It has to be strictly for investment purposes. If you were to live in the property, either rent-free or paying yourself rent, it would be problematic either way. Lastly, just other things, again, getting back to specifically talk about real estate, if you own real estate in your IRA and it needs work, you need to replace the carpet, you need to paint the walls, replace the roof, it is expected that your IRA will actually pay third parties to do that work. It is prohibited for you to put in your own sweat equity to do your own maintenance for that property. So that's, again, one thing that comes in play when it's specifically talking about real estate as an investment. All right, I'll switch gears now and go into some of the case studies that show you kind of how the process works of a self-directed IRA and hopefully flesh out some more of the rules that we would talk about as well. Our first case study have John Smith. He's a former postal employee. He currently has a TSP plan with over $300,000 built up in it, but he's looking to buy a piece of vacant land. It's only going to be about $30,000 or so. So he elects to do a rollover, or a direct rollover from the TSP plan of the $30,000 into the traditional IRA. So John would contact Advanta. We would set up an IRA account for him by having him fill out the paperwork. And then he will contact the TSP plan to request them to roll over the $30,000 into the IRA. Now, when he finds the property that he wishes to purchase and write the contract, it's very important that the name on the contract be the name of his IRA account. This demonstrates to the IRS, anybody else involved, that this investment is in his IRA. Therefore, the money that leaves the IRA to pay for the property at closing, it's a non-taxable event. As well, if he were to receive any rents or dividends or income or maybe profits on the sale, all of that also will come back into the IRA tax deferred. So the contract should be in the name of Advanta IRA for benefit of John Smith's IRA and his account number. So we would help John Smith in this instance get that contract written in the name of the IRA. John would complete a form for us telling us what exactly it is that he's looking to purchase. It's called a purchase authorization form. And in that document, he will let us know who the title company is, or the attorney who is going to handle the actual real estate closing. And our job will be to contact that attorney, contact that title company, and make sure that the wording for his IRA, again, that Advanta IRA for benefit of his name and his IRA account, shows up on all of the closing documents, whether it be the settlement statement, the deed, the title policy. Our job is to make sure that that wording is correct and appears on all of the closing documents before we actually execute the closing. Now, Advanta IRA does sign on behalf of the IRA account. We have the signature authority to sign and bind the IRA on the contract and ultimately on the purchase. But we will not sign any documents. We will not wire any funds out of the account until the client, in this case John Smith, has reviewed and approved all of the documents for us. So the client is involved every step of the way to make sure that not only the documents have been approved, and make sure that the settlement statements are, but also any legalese contained in those documents. Again, our job is to simply make sure that the wording is correct and that his IRA is properly, but up to the client to review the documents and then make sure that the deal is exactly as it's supposed to be. When the property sells, the proceeds will all come back into the IRA account. In this case, tax deferred because it's going into a regular IRA account. If he had sold this property with under a year's time, any profits that he would receive would be subject to ordinary income. But since this is inside an IRA account, the full amount of the proceeds just go right back in his IRA, and he's got money ready to make his next investment. All right, the next example is when I was talking about the prohibited transactions and people who, the disqualified persons. But I mentioned that it was possible for disqualified persons or disqualified entities to actually partner up on a transaction. And this particular deal illustrates that principle. We have Paul and Linda, who are husband and wife. They each have kind of an old 401k plan from a previous employer, but they're interested in buying real estate. They want to kind of combine their funds to buy a piece of property. In this example, the property is for sale for more than either one of them has in their account, and there's going to be some additional work that needs to be done in order to get that property ready to rent. But they figure once they get this property purchased, get it fixed up, they'll get a nice cash flow back into their account. So they can use both of their IRAs or old 401ks here together as partners in the particular deal. Again, this situation, how the case study is laid out, Paul's IRA is not buying real estate from Linda's IRA, or vice versa. Her IRA is not buying from him. But both of their IRAs ultimately are going to be buying the real estate from a third party, and they're going to hold title as tenants in common. So similarly to what we did with John Smith, Paul and Linda would open up their accounts, fill out our paperwork to get an IRA account open, and then direct their old employer to do the rollover of the funds into the self-directed account. Paul and Linda will find the investment property and make the offer to purchase. Again, we do not get involved in identifying a property or identifying a proper purchase amount. Those decisions are solely within the domain of the client as an individual. We do not, again, if you came to us and wanted to make a low-ball offer, our job is to make sure that offer is titled in the name of the IRA and then sign off. So it's all the picking of a property, deciding what to offer is up to the client to decide what they want to do. And we'll go through the closing process much like we did in the last transaction. We will contact the title company to make sure that the buyer's name is the IRA account, in this case both IRAs, and we'll also want to make sure that each IRA is reflected as a percentage owner based on what they put into the deal. In this case, we would be signing on behalf of both Paul and Linda's IRA, so we will need both Paul and Linda to mark the documents as read and approved before we can actually send the funds out. So both Paul and Linda will be required to review the settlement statement, the deed, the contract, etc., all the closing documents. At that point, we will sign the documents on behalf of their IRA and then wire the funds out of their two accounts to make that purchase. Now, since they're buying properties as partners, the deed will need to reflect both IRAs as owners as tenants in common. So you can see here on this slide, this is the wording that would appear on the deed. Advanta IRA for benefit of Paul's IRA as to a 50% undivided interest, and Advanta IRA for benefit of Linda's IRA as to a 50% undivided interest as well. So it's very clear that each of their IRAs owns their own 50% interest in the particular property. And the percentage, in this case, in the way the numbers worked out when we did the example, Paul and Linda were putting in equal parts, therefore they would have a 50-50 ownership split. But if one of their accounts had more cash in it than the other, they would be permitted to still partner, but the percentages would be different. The percentages must be based on what is coming from each IRA account, no more and no less. So if Paul's IRA was contributing 30% to the deal and Linda's was contributing 70%, then the ownership needs to be reflected along that same percentage. To do it 50-50 would be prohibited if the monies aren't coming equally from each different account. So our job at Advanta initially is helping a client get an account opened, getting funds transferred or rolled over from an old employer's plan, and then actually going through the closing process of making an investment in purchasing the particular property, making sure it's titled, make sure their clients have approved it. Once that has been done, our record-keeping function really kicks in, and that's where we spend most of our time in dealing with clients, is now that they, in this case Paul and Linda, have bought this property with their two IRAs, any expenses they have for this property, the repairs, the maintenance, taxes, insurance, must be paid from the IRAs based on the percentage of ownership. So since they own the property 50-50, every bill, whether it's repairing the roof, whether it's the insurance bill, whether it's the tax bill, 50% will be of that each bill will be paid out of each of their two IRAs. And our job at Advanta will be to process those checks out of the IRA to pay the bill. So Paul and Linda can simply fax us the tax bill each year, or fax us their repair bill. We will then get a check cut out of their account and sent to pay their vendor. Likewise, when the property gets rented, all of the rental income will be sent directly back to us for deposit into their account. So the renter can simply make out a check to Advanta IRA and give us both Paul and Linda's account numbers, send it to us, and we will then split the rent and deposit into both of their accounts. And Paul and Linda will have online access to check their account at any time to make sure that payments are indeed coming in. Also, they will be able to they'll receive email notifications. Anytime money comes in or money leaves their account, our system will send them an automatic email letting them know of the activity that is occurring within the given account. Next case study switched gears just a little bit. The last two examples were, again, an example where old 401k funds were used, or a TSP plan as well, used to buy real estate, where the IRA ultimately was on title to and be the owner of record to a particular piece of real estate. But one other arena that we see quite a bit of activity in from time to time is individuals using money and being a source of, basically being a private lender for other people looking to make different deals. In this case, we have Laura, who has money in a 403B plan. She's over 59 and a half, so she has the ability to take to do rollovers from that plan whenever she'd like. But she's really not interested in owning property. Again, this common with a lot of our clients, wanting to basically be involved in real estate without having to be responsible for selecting a property and getting it rehabbed. But she meets Ray. Ray is looking for funds. He wants to find a property, get it fixed up, get it sold, but he needs capital to do it. Doesn't want to go to a bank or likes to working with private lenders instead. So Ray meets Laura, introduces his deal, tells her what what's going on, what he's looking for. Laura's job, again, as the account owner, do her due diligence on the investment. And again, going back to the two previous examples, as the client, as the investor, the IRA owner needs to do their due diligence, to get an appraisal done, look at a property, making sure it's what they want to get involved in. In this case, Laura should probably not only do due diligence on the property that Ray's looking to buy, but certainly do her due diligence on him as well and make sure that he's an upstanding guy. Again, in Advanta, we do not run credit checks. We do not require appraisals. We do not make any final decision on the loan. That is up to the client. But Laura is satisfied for what he's looking for and the terms involved, and she offers to lend him the $80,000. Now, when your IRA is lending money and doing a private loan, the neat thing to me, and I've always found very interesting about that, is your IRA gets to act as a bank. So someone's borrowing money from a bank, they go to a bank, they sit down, they offer up their collateral, their credit, how much they're looking at borrowing, and the bank will then dictate to them the terms for which they will do the loan. The bank will tell you how much they're willing to loan on a property, what the interest rate will be, what the length of term will be, et cetera. So if someone's coming to your IRA and wanting to invest with you and use your IRA for their investment, you get to set those same terms for them. How much are you willing to lend? What's your interest rate going to be? What are you going to charge them to borrow your funds? In this case, with Laura, she's saying, well, what about equity participation? Ray is going to be rehabbing a property and possibly making a lot of profit. I may not want just a straight interest rate. I might like to see some of his profits going forward. And so she writes in some equity participation language to the note and mortgage as well. So establishing the note terms when you're a private lender, all of these different terms, the amount you're lending, the interest rate, et cetera, is up for you to decide between you and your borrower. And in this situation, this particular client, when she was doing this loan, now in most circumstances, if you were lending money to a rehabber on a straight interest rate, kind of a hard money loan, you might be looking at 10 or 12% as the interest rate, and that's what Ray might expect to pay. But with this particular client, she worked with the borrower, in this case the rehabber, and agreed to only do an interest rate of only 6%, so the lower carrying cost for the rehabber, but he was willing to give her then 25% of the profit. So anything he sold the property for over and above the $80,000, she'd get her principal back, she'd get her interest, and she would get 25% of his profits as well. So they secured this with a first mortgage. So if Ray is unable to finish the project or runs out of funding or just kind of disappears, Laura would at least be able to foreclose on the property, have that property then come back into her IRA account. Again, maybe not ideal, but at least protects her with the first mortgage, allowing her to recoup some of her funds. Now, the last case strategy I'll talk about today, I alluded to in the beginning in talking about a single-member LLC, or what they refer to in the industry. If you were to Google and talk to a lot of people, they refer to it a lot of times as a checkbook-control IRA, or a checkbook IRA, or a checkbook LLC, a lot of different acronyms that it goes by. But essentially all what individuals are referring to in that scenario is a situation where an individual uses their IRA to establish a brand new LLC or at times using a private trust, which allows them to gain greater control over the cash in their account to disperse for investments, pay bills, etc. Now, in the example that we did with Paul and Linda earlier, any bills that they had, they would send the bill to Advanta. We would cut a check out of the cash in their account and get those bills paid, and also receive and deposit rents directly into their IRA accounts. That's generally speaking how most of our clients handle their real estate purchases. But what the Checkbook-Control IRA LLC allows an individual to do is take the cash that's within their IRA and move it into an LLC or similar structure that gives them personally direct control over the cash. So it allows the manager and the IRA owner to write those checks directly for investments. And again, most often the kind of true checkbook control is a situation where you would set up an LLC. It would be a brand new LLC. The IRA is named as the sole member, owns 100% of the LLC, and then the IRA owner names themselves as manager. And so that gives them the ability to write the check, set up the bank account, etc. We do encourage you, if you're going to set up this type of structure, to get some guidance from an attorney or maybe a CPA who can let you know kind of what the rules are, give you some more pointers on what to do or what not to do when managing that type of LLC. If you do elect to use a trust, instead of using an LLC, some people choose to use a trust. We do require you to have a third party as the trustee. So if you're the IRA owner and you want to act as trustee, that would not be allowed. If you wanted to be the manager of an LLC, it's a little bit different story because there's case law that supports the IRA owner being the manager of an LLC. There is no same case study for using a trust. The Checkbook-Control LLC, again, there's custodians out there that offer a one-stop shop where they'll set up the IRA, they'll set up the LLC, help you get started, but they charge $3, $4, $5 grand to actually get that whole process up and going. There's no secret formula that those companies have. They've access to the same case studies that we have, same court cases that the tax court has decided over the years. And we can allow you to do that investment through the IRA with us, and you can find an attorney or CPA and pay far less than the thousands of dollars that those other companies will charge. Now, the checkbook LLC industry really started after the case of Swanson v. Commissioner back in 1996, a case in which Swanson, the taxpayer, created a brand new corporation, had his IRA buy all the shares in the corporation, so his IRA was the only shareholder in that corporation, and then he named himself as president of the corporation, and then that corporation did various dealings in buying and selling assets, with all the income ultimately accruing back into his IRA and into his retirement account. The IRS challenged Mr. Swanson back in 1996 and said that it was prohibited for him as the IRA owner to manage that particular corporation because of the fact he was a disqualified person. Well, the tax court back in 1996 disagreed with the IRS and held that because it was a brand new corporation, it could not be prohibited for Swanson's IRA to actually buy the shares in that particular entity. And they actually confirmed that back in 2013 as well in the tax court memo regarding T.L. Ellis. The IRS again challenged that type of structure, and the tax court again held, citing the Swanson case, that it is permissible for an individual to act as a manager of the LLC so long as they aren't being compensated. And that was one thing Mr. Ellis did incorrectly, was that he paid himself from his IRA to actually to be the manager. That the tax court held was prohibited, but they did confirm if you're setting up an LLC that your IRA, with your IRA as the member, that it is permissible for you to be the manager so long as you don't compensate yourself. Now, some of the advantages, why do people want to use a private trust or use a private LLC? A couple different concerns, or a couple different, I should say, motivators for individuals choosing this course of action. One is anonymity. Some individuals do not want their name on public record, or don't want it on public record that their IRA owns a particular property. Now, if you're only concerned with having your name on public record, we can title real estate as Advanta IRA for benefit of account number such and such and leave your name off it altogether. So there would be some, if that was your only concern. But an LLC or trust can give you additional protection there. But probably the biggest reason individuals choose to use a Checkbook-Control LLC or trust is really the control aspect. Again, if we are holding title, if Advanta is holding title to the real estate, we would be receiving rents and we would be paying bills at the client's direction. And some individuals simply want greater control over that. They want to be able to write the checks themselves as they need them. They want to be able to deposit the rent into a bank account for the LLC. If you're buying property at auction, an LLC can make that much easier as well. So for some, and for most, I would say it's usually the control aspect. Some clients who have a lot of turnover, you're making a lot of different investments where you're buying and selling assets. By using an LLC, you'd be able to hold assets, more assets within that structure, but pay much lower fees to Advanta. We are not commission-based, but we do charge for our administrative services. So as we buy do different transactions, buying and selling, going through closing process, we have a transaction fee each time. So using an LLC or trust can help you limit that if you are buying and selling a lot of different assets. That being said, there's definitely some disadvantages to using and things to think about before you engage in using a checkbook LLC or a private trust. One, although the IRS has said that it seems to be, it's okay for you to act as a manager of the LLC, just because you're the manager doesn't mean that what you do within the LLC is going to be blessed or is going to be okay within the IRS rules. Some of the bigger dangers that we see with a checkbook LLC is for the individuals who are running those with their IRA accounts is really the fact that you now as the IRA owner are responsible for keeping all of your records. So you need to make sure you keep documentation of every penny in and out of the account. So if the IRS were to ever audit you, you'd be able to show where all the funds have gone and what they've gone for within that particular LLC. And it's also something that can be easy to engage in a prohibited transaction. If you have the checkbook for the LLC and you want to make a loan to your son and you forget the rules that he is disqualified and that's not allowed, you can write the check simply right out of your bank account. Before you know it, you've done something that's prohibited. If you were to try to do those transactions through Advanta, we will not allow anything we can see or knowingly is prohibited. So we've had a couple clients get nicked by that, where they indeed did something prohibited within their checkbook LLC, simply because the access to the checkbook, it was easy for them to do, and they didn't think to call us and ask us ahead of time if what they were thinking about doing would ultimately be allowed or not. So the fact that there's improper, the risk for not keeping good records, engaging in prohibited transactions, again, there's just a lack of oversight by us as the administrator. We ask once per year if you have a checkbook LLC that you update us as to the value, but we do not have to bless or approve any transaction throughout the year. Now, if you are investing through us and buying and selling real estate through us, we might be able to catch you doing something that's prohibited. If you're buying a piece of property from your son and we can tell right off from the documents that that's your son, we won't handle that transaction. We won't even do it. So it can certainly protect you in the long run. It might be worth it to go ahead and, if you're concerned about fees, pay a little bit more, knowing that we are handling all of the income and expenses and keeping accurate records should the IRS ever look into it. Getting started, if you have an old 401k, a 403b, 457 plan, or even an IRA with another firm and you're looking to get going, the process is fairly straightforward. It's a matter of opening an account, basically filling out our application paperwork to open up an IRA, name your beneficiaries, etc., and then fund your account by, if you're moving money from an old 401k, it's by contacting that company, the administrator for that firm, and requesting a rollover. And they will then send a check payable to your IRA. We deposit it into the account. Or if you're transferring from another IRA, having that money send a transfer form and get that funded as well. Then ultimately choose the investment after that. We've opened the account, we funded it with a rollover, a transfer, and then ultimately you're telling us what to invest in. And then we would take your direction to make sure the assets get titled correctly in the name of the IRA. I did have another question pop up on the screen. If you have anybody else that's listening live, have another question, please make sure you get it typed into the chat box here. The question said, where do checks from the IRA account get mailed? Where does the income get mailed? It actually gets mailed to our office in Largo, Florida. We will receive the check, deposit it into the account, And then again, the client would be able to see that online and also would get an email notifying them when that check and that income has arrived. Now, most of our clients, when they have a rent check or maybe a payment on a loan come in, they do have those checks mailed directly to our office, and as long as it identifies your account and we know exactly who it's coming from, we will be able to deposit that to your account. We also have had some clients, it's permissible, that want to receive the check personally to make sure that it gets paid. If you collect the rent check from or a payment check from your tenant or from your borrower, have them make the check out to your IRA account, mail it to you, and then from there, you send it to us for deposit into your IRA. That is acceptable as well. What you cannot do is take the check personally and deposit it into your own account. We cannot, and then write us a check for that amount. So the check does have to be deposited directly from your borrower into your IRA, but if you want to collect it first, that's fine, or you can have them simply mail it directly to our office. That concludes our the webinar today. My contact information here is on the last screen for anyone who wants to follow up with additional questions, either to set up a one-on-one meeting. I'd be more than happy to do that. You can email me, call me with questions you have, or to set up that meeting. I'd be happy to reach out and get that scheduled. And you can also visit our website at advantaira.com. For the other upcoming events and seminars that we have, all of our education is free. Whether you're participating in the webinar today or whether you come to one of our live lunch and learn seminars that we do in our Atlanta and Tampa offices, please come, grab lunch on us, and learn a little bit more about self-directed IRAs. So we really encourage people to take advantage of those educational opportunities. So at this point, I don't have any other further questions, so I'm going to conclude the webinar, and I want to thank everybody for participating today.